The debt ceiling is a limit set by the United States government on the amount of money that it can borrow to finance its operations. When the government reaches the debt ceiling, it cannot borrow any more money, which can lead to a range of consequences that can affect the markets and your daily living. Here are a few ways the debt ceiling can affect the markets. Increase in interest rates. If the government reaches the debt ceiling, it could lead to a default on its debt, which would cause interest rates to rise. This increase in interest rates could lead to a decrease in investment, which can have a negative impact on the stock market. Market volatility. Uncertainty surrounding the debt ceiling can cause market volatility. As investors try to predict how the government will resolve the issue, the markets can experience significant fluctuations. Downgrade of credit rating. If the government defaults on its debt, it could lead to a downgrade of the country's credit rating. This downgrade would make it more expensive for the government to borrow money in the future, which could lead to a decrease in investment. As for your daily living, the debt ceiling can indirectly affect your finances in several ways. Interest rates. If the government defaults on its debt, interest rates will rise, making it more expensive for you to borrow money for things like mortgages, car loans, and credit cards. Inflation. If the government prints more money to finance its operations, it can lead to inflation, which means that the value of the dollar decreases. This decrease in value can lead to an increase in the cost of living, making it more expensive for you to purchase goods and services. Government shutdowns. If the government reaches the debt ceiling, it can lead to a government shutdown, which means that non-essential government services will cease. This shutdown can affect your daily life in a variety of ways, such as delayed tax refunds, closed national parks, and furloughed government workers. Overall, the debt ceiling can have a significant impact on both the markets and your daily living. It's important to stay informed about any developments surrounding the debt ceiling to understand how it could affect you. If the government defaults on its debt, it means that it has failed to make payments on its outstanding debt obligations, which can have significant impacts on the markets and Main Street. Here are some of the potential consequences. Market volatility. A government default would likely lead to significant market volatility, as investors would become nervous about the government's ability to repay its debts. This could lead to a sharp sell-off in the stock market and a flight to safe haven assets like U.S. Treasury bonds. Increased borrowing costs. If the government defaults on its debt, it could make it more expensive for the government to borrow money in the future. This could lead to higher interest rates for both the government and consumers, which would make it more difficult and expensive to borrow money for things like mortgages, car loans, and credit cards. Credit rating downgrade. A government default would likely lead to a downgrade of the country's credit rating, which would make it more difficult and expensive for the government and private companies to borrow money. This could have a ripple effect throughout the economy, as companies may struggle to access credit to finance their operations. Economic recession. A government default could potentially trigger an economic recession, as the resulting market volatility and increased borrowing costs could lead to decreased consumer spending and business investment. On Main Street, a government default could have a range of effects, such as increased borrowing costs. As mentioned above, a government default could lead to higher interest rates, which would make it more expensive for individuals to borrow money for things like mortgages, car loans, and credit cards. Job losses. A government default could potentially trigger an economic recession, which could lead to job losses across a range of industries. Government service disruptions. If the government defaults on its debt, it could lead to a government shutdown, which would disrupt government services like tax refunds, Social Security payments, and other services that rely on government funding. Overall, a government default would have significant and far-reaching consequences for both the markets and Main Street. It's important for policymakers to work together to avoid a default and ensure the stability of the economy. If you enjoyed the video, please give me a like and subscribe to the channel. Stay informed.